The trigger most people missed isn't a headline, a vote, or a single economic print. It's the moment the system quietly shifts from managing the cycle to managing the consequences. And when that shift happens, the path is not political, it's mechanical. Here's the claim that sounds extreme until you trace the plumbing. The dollar system is entering the phase where it can only remain stable by exporting instability, and the export mechanism is already visible in FX stress, in auction behavior, in funding spreads, and in the widening gap between paper claims and real deliverable collateral. In that phase, silver and gold don't need permission to reprice. They simply become the shock absorber that the rest of the system refuses to be. Recent estimates put total global debt, sovereign, corporate, and household, at roughly $300 trillion, give or take depending on methodology. That number matters not because it's a trivia record, but because it defines the boundary conditions. A debt stock that large cannot be paid down in real terms without either a deep deflationary contraction or a long inflationary dilution. Both paths are politically intolerable, so the system chooses the third path, rolling the liability forward through liquidity engineering and then trying to manage the side effects with narrative. That is why the pattern is mathematical. If you require perpetual refinancing at scale, you require stable funding. If you require stable funding, you require confidence in collateral and currency. If collateral or currency confidence cracks, you either raise the price of money, yields, and trigger a contraction, or you suppress yields and trigger a currency problem. There is no escape hatch. There is only sequencing. The dollar is not merely a domestic unit of account. It is the global funding rail. It prices commodities. It collateralizes trade. It sits inside cross-border bank balance sheets. It underpins derivatives margins. And it is the cleanest dirty shirt in a world that still settles obligations in a single dominant language. That dominance comes with a hidden cost. The world runs short dollars whenever volatility rises, and the system responds by manufacturing them through central bank swap lines, bank balance sheet expansion, and risk-off flows into treasuries. When the system works, the dollar strengthens in crises and then softens when liquidity returns. When the system breaks, the dollar strengthening becomes destabilizing because it tightens global financial conditions to the point of fracture. That's the first sign of the shift. The dollar stops being a safe harbor and starts behaving like a stress amplifier. So what is the fixed mechanism? It always begins with a setup that looks rational, almost virtuous. A new regime, a new anchor, a new promise that the unit will be stable and credit will be plentiful. Then comes expansion, credit growth, fiscal reach, monetary accommodation, or some combination, where the promise becomes a lever. At first, it produces real growth, then it produces asset inflation, then it produces dependency. After enough time, the system can't tolerate normal interest rates or normal settlement discipline, so it stretches. That stretching is what people call debasement, even when no one is physically clipping coins. It is the dilution of real purchasing power through policy that chooses more claims over hard constraints. Then comes crisis, a loss of control. The crisis is not the first bad year. It is the first moment the market stops believing the manager can close the loop without breaking something else. Finally comes the inevitable outcome, an explicit reset, a broken peg, a restructuring, a devaluation, a regime change in the unit of account, or a forced repricing of the outside money that has no counterparty. Gold and silver have played that outside money role for centuries, not because they are magical, but because they are settlement without permission. The market turns to them when confidence in paper claims turns from faith into calculation. When you apply that mechanism to the modern world, you have to stop thinking in slogans and start thinking in pipes. Liquidity is not sentiment. Liquidity is the ability to fund positions, roll liabilities, clear trades, and meet margin calls without forced liquidation. And the dollar system is a hierarchy of liabilities: bank deposits, treasury bills, repo collateral, swap lines, derivatives, margins. The hierarchy works until it doesn't. When it doesn't, volatility spikes, not because people suddenly feel scared, but because the cost of financing uncertainty rises. That cost shows up in yields, in term premiums, in bid-to-cover ratios at auctions, in the spread between secured and unsecured funding, and in the basis between paper and physical commodities. That is exactly why silver and gold belong in this story, not as inflation hedges in the simplistic sense, but as collateral alternatives when the system's preferred collateral becomes politicized, reapothecated, or distrusted. Start with bonds. The Treasury market is the spine of the global collateral system. When yields rise, it's not only about mortgages get expensive, it is about the discount rate on everything and the mark-to-market of the safest collateral in the world. A large move in yields is a large move in collateral value. That is a margin event. Margin events are volatility machines. When yields rise fast, leverage has to shrink. Shrinking leverage is deflationary. It crushes risk assets, it tightens lending, it forces liquidations. But when yields are suppressed below the inflation rate for long enough, you get the other side of the vice. Currency debasement, negative real returns, and eventually a foreign buyer strike. That is where FX stress enters. Foreign holders don't care about your domestic narrative. They care about real return in their currency, and about the political risk of being last in line when everyone rushes for the same exit. Now, case studies, not decorative history, proof of mechanism. The first is the interwar catastrophe that began with a rational promise, the post-World War I settlement architecture. The Treaty of Versailles in 1919 did not just assign reparations, it set the stage for a funding and currency trap. Germany faced reparation obligations denominated in foreign currency and gold marks, while its domestic economy needed liquidity to rebuild and political stability to survive. The setup looked like moral accounting. The expansion phase came when the German state, constrained by external liabilities and internal unrest, relied increasingly on monetary finance. By 1923, the Reichsbank's accommodation, buying government obligations and enabling deficit spending, accelerated. People remember wheelbarrows of paper, but the deeper point is the mechanism. External claims and internal politics forced the system to choose printing over contraction. That was debasement, not as ideology, but as necessity. Then came the crisis phase. Loss of control. Once wages and prices began indexing upward, the currency's velocity rose. That is the moment central bankers fear, when policy is no longer steering demand because the public is front-running the currency's collapse. Imports become unaffordable, tax receipts lag in real terms, and the state prints more to keep up, which accelerates the cycle. The inevitable outcome arrived not with a polite policy pivot, but with a reset. The Rentenmark in late 1923, backed not by a return to abundant gold, but by a new structure and credibility constraint. Land and industrial assets as a psychological anchor, and strict limits on issuance. The old unit died because the market refused to hold it. The reset was forced, not chosen. That is the full mechanism. Setup of obligations and promise, expansion to meet them, debasement as the lever, crisis as the velocity regime shift, outcome as a new unit and new constraints. The lesson for today is not America will hyperinflate. The lesson is colder. When external obligations and internal politics collide, the currency becomes the release valve until confidence breaks and the system requires a reset. The second case study is the end of Bretton Woods and the 1970s stagflation, an example closer to the modern dollar system, because it involves a dominant currency attempting to promise external convertibility while running internal policy that made the promise impossible. Bretton Woods, formalized in 1944, built a post-war setup, currencies pegged to the dollar and the dollar pegged to gold at $35 per ounce. It worked because the United States held the largest gold stock and ran a strong external position. That was the foundation: stability, trade expansion, and rebuilding. The expansion phase arrived as global trade grew and the world demanded more dollars to settle it. Dollars flowed abroad through U.S. deficits, foreign aid, military spending, and investment. Over time, the supply of dollars held by foreign governments grew larger than the U.S. gold stock available to redeem them at the promised price. This was not a conspiracy. It was arithmetic. The system's success created its vulnerability. Debasement arrived in policy form. During the 1960s, U.S. fiscal pressures, Great Society spending, and Vietnam War costs, combined with accommodative monetary policy, domestic inflation rose. Foreign central banks watched the real value of their dollar reserves erode while the gold promise remained fixed. They did what rational actors do. They tested the promise. By the late 1960s and early 1970s, redemption pressure intensified. The London Gold Pool, an earlier attempt to manage gold price stability through coordinated sales, had already collapsed in 1968. That was a warning flare. Managing the metal market is a temporary patch, not a solution, when the underlying liability growth continues. Then came the crisis phase. Loss of control. On August 15, 1971, President Richard Nixon suspended the convertibility of the dollar into gold, effectively ending the Bretton Woods promise. That decision is remembered as the Nixon shock, but the important point is that it was the inevitable outcome of the mechanism. The system could either contract dollars, crush domestic growth, and defend gold at $35, or it could sever the anchor. It severed the anchor. The outcome was not stability. It was a decade of inflation, energy shocks, and currency volatility. The dollar weakened, commodities repriced, and gold, freed from the peg, moved from $35 to over $800 by 1980. That was not a gold bug fantasy. It was the market repricing an unanchored unit during an era of negative real rates and policy credibility loss. Again, setup, expansion, debasement, crisis, outcome. The outcome included a forced restoration of credibility later, Paul Volcker's aggressive rate hikes beginning in 1979, 1981, because once inflation expectations are unmoored, the only tool left is pain. That is what the mechanism demands when the manager wants to rebuild trust. Hold those two case studies side by side and you can see the invariant. In both, policymakers did not wake up and choose chaos. They made rational local decisions inside a system whose global constraints were tightening. The crisis was simply the point where the constraint became visible and the market stopped accepting the story. That is why this is relevant now. We are living inside a regime where the dominant currency is also the dominant funding instrument, and where the world's debt stock requires perpetual liquidity provision. That combination can look stable for years, until it doesn't, and then it moves fast. This is where the trigger most people missed becomes concrete. People think in headlines, but the system moves in spreads. Watch how the market treats duration at auctions. Watch bid to cover in the tails. Watch whether foreign official buyers are steady, or whether the marginal buyer is domestic leverage. Watch repo conditions. Specials? Fails? The cost of funding the safest collateral. Watch dollar strength versus high debt emerging markets versus Europe versus Japan. Watch whether central banks are intervening to slow their currency's decline, because intervention is the canary. It's a recognition that FX moves are transmitting financial conditions faster than domestic policy can manage. Inflation and deflation are not mutually exclusive here. The system can produce deflationary episodes, liquidity shocks, asset crashes, inside a longer inflationary dilution. That is what makes the moment feel confusing to most people. They see prices rising and assume inflation forever. Then they see markets crash and assume deflation wins. The mechanism allows both, sequentially, because it's a funding mechanism. When liquidity breaks, everything is sold to raise dollars, deflationary impulse. When policy responds by flooding the system to prevent collapse, purchasing power is diluted, an inflationary impulse. The path is not a straight line, it is a ratchet. Now bring in precious metals, because the metals are where the abstraction meets physics. Gold and silver sit outside the banking system in a way that most assets do not. A Treasury bond is a claim on the state in the state's unit. A bank deposit is a claim on a bank backed by a state. A futures contract is a claim on a clearinghouse structure. Gold and silver in allocated form are not claims. They are settlement assets. That distinction matters most when confidence is questioned. And the modern market has layered claims on top of physical inventory to the point where the paper float can be multiples of deliverable supply. That is efficient when everyone rolls contracts and trusts the system. It becomes a problem when people want delivery. Silver is more fragile than gold in the plumbing sense. It is smaller, more volatile, and more industrially entangled. Inventory drawdowns can matter because a relatively small shift in physical demand, industrial, investment, or strategic, can tighten availability. When tightness rises, premiums rise. When premiums rise, you see the split between spot price and real-world acquisition cost. That is the tell. It is also why the price people quote on screens can become a psychological anchor that stops functioning. In stress, markets reprice to where supply meets demand. And sometimes that repricing happens not through the screen price rising smoothly, but through availability collapsing and premiums exploding. That is the mechanics of a shortage in a paper-dominated market. Gold, by contrast, is deeper and more monetary. It tends to be the reserve asset central banks return to when they want to diversify away from political risk. If the world begins to question whether the dollar can remain the unquestioned reserve without generating unacceptable domestic trade-offs, gold becomes the neutral alternative, not because it yields, but because it doesn't default. In a world of increasing sanctions, financial fragmentation, and friendshoring, neutrality becomes a feature. Silver can then behave like the leveraged cousin, smaller market, bigger percentage moves, more violent squeezes when liquidity rotates. This is where the dollar machine's final phase begins to reveal itself. A reserve currency that must supply liquidity to the world is forced to run deficits over time. Those deficits create claims. Those claims grow. At some point, the system becomes too claim-heavy to tolerate real yields that compensate holders. If yields rise to compensate, debt service becomes a fiscal crisis. If yields are suppressed to protect the fiscal position, the currency becomes the adjustment mechanism. That adjustment shows up first in FX. Other currencies weaken, import prices rise, inflation transmits unevenly, and central banks are forced into policy paths that don't match their domestic economies. Then it shows up in volatility. Currency swings feed hedging costs. Hedging costs feed funding stress. Funding stress feeds risk asset liquidation. Finally, it shows up in collateral, in repo, in margin, in the ability to warehouse risk. Once the marginal buyer of treasuries demands higher yields at the same time the system can't afford them, the manager is cornered. None of this requires a dramatic collapse tomorrow. The terror is that it doesn't. The mechanism can grind. It can produce a series of manageable episodes that each justify more intervention, more balance sheet elasticity, more regulatory pressure on banks to hold safe assets, more reliance on a shrinking set of true dealers to make markets. But every intervention has a cost. Each time you stabilize the surface, you deepen the dependency underneath. And every time you deepen dependency, you increase the size of the next intervention required. That is the ratchet again. In the interwar case, the ratchet was printing to meet obligations until the unit died. In Bretton Woods, the ratchet was exporting dollars until the gold promise died. In both, the final phase was not the first policy mistake. It was the final recognition that the old anchor could not coexist with the required expansion. That recognition is always delayed because acknowledging it is politically radioactive. But markets don't wait for speeches. Markets wait for settlement. So when you hear silver $200, gold $6,000, treat it as a directional expression of what happens when the system reprices the outside money that sits beyond counterparty risk. Those numbers are not the point. The point is the repricing function. When policy is forced into a choice between currency credibility and funding stability, it will choose funding stability first because the immediate alternative is disorder. That choice is the hidden trigger. It changes the incentive structure for every global holder of dollar claims. It turns hold dollars for safety into hold dollars until you can rotate. And once rotation begins, it doesn't require everyone. It only requires the margin. The next step is to map this mechanism onto today's live wires. The auction calendar, the debt rollover wall, the maturity profile, the global effects lines, and the fragile funding that keeps risk assets levitated. That mapping is not a prediction exercise. It's a sequence exercise. And once you see the sequence, you'll understand why the biggest move in metals often begins when the world is focused on the wrong threat. Because the real threat is not the headline, it's the funding. The uncomfortable truth is that we have already seen the early signals, repeated episodes of stress in money markets, periodic strains in collateral, sudden FX dislocations, and policy responses that grow more permanent each time. The system is not failing in a cinematic way. It is revealing its constraint in a mathematical way. And that is why the present-day application is the part most people avoid, because it forces you to look at the exact point where the loop stops closing cleanly and where the exit valve starts taking pressure. That is where we go next. Into the live dollar machine, the FX stress transmission, the yield path, the liquidity cycle, and the precise reason silver and gold become not a trade, but a settlement choice when the market finally prices the constraint instead of the story. That is where we go next. The live dollar machine, the FX stress transmission, the yield path, the liquidity cycle, and the precise reason silver and gold become not a trade, but a settlement choice when the market finally prices the constraint instead of the story. So now we add the third proof point, because the mechanism isn't theory until you watch it repeat in a modern, liquid, globally integrated market where policymakers believe they have tools. The third case study is the break of the European exchange rate mechanism in 1992, Black Wednesday, and it matters because it wasn't a failed country with weak institutions. It was the United Kingdom attempting to defend a policy promise against a market that understood the arithmetic of capital flows, interest rate differentials, and recession dynamics. The setup looked respectable. The UK joined the ERM in October 1990, effectively promising to keep the pound within a defined band against the Deutsche Mark. The promise was credibility. The promise was discipline. The promise was that anchoring to Germany's hard money reputation would import stability. Then expansion and overextension arrived in the form that always appears. Policy choices that are rational locally but incompatible globally. Germany reunified in 1990, fiscal demand surged, and the Bundesbank kept monetary policy tight to contain inflation pressure. That meant high German interest rates. The UK, by contrast, was walking into recession, and the domestic economy needed lower rates, not higher. But the peg required alignment. The UK had to keep rates high enough to defend the pound and prevent capital from fleeing into the mark. That's the trap. Once you commit to an external anchor, your domestic cycle becomes subordinate to the defense of that anchor. The debasement in this case wasn't printing press imagery, it was credibility dilution, spending reserves, signaling determination, attempting to overwhelm a market that could move more capital than any central bank could credibly burn for long. The crisis phase arrived as speculative pressure built, and the market tested the will and capacity of the state. On September 16, 1992, the Bank of England spent billions of pounds of reserves and hiked rates aggressively, famously announcing a jump to 15% to defend the currency. It didn't matter. Capital outflow and selling pressure overwhelmed the defense. The inevitable outcome was the exit from the ERM and a sharp pound devaluation. That episode proves the mechanism in a clean, modern form. A foundation promise creates stability until it creates constraint. Expansion forces contradictions to accumulate. The crisis emerges when the market recognizes the contradiction and presses it at scale. The outcome is not negotiated, it is forced by funding realities. And the lesson is not pegs always fail. The lesson is harsher. When the policy path required to maintain credibility is incompatible with the policy path required to sustain the domestic economy, the currency is the release valve. The only question is whether the release valve opens gradually or violently. In 1992, it opened violently because the promise was explicit, the market was liquid, and the contradiction was immediate. Today's dollar promise is different. There's no gold peg, no ERM band, but the contradiction is larger. The dollar must be both the world's stable unit and the world's elastic funding instrument, while the U.S. must refinance a debt stock that is too large to tolerate sustained high real yields. That is the modern contradiction, and it is why the mechanism is now migrating from a currency peg story into a global collateral and funding story. Now we apply the mechanism step by step to the present with the plumbing exposed. Start with the foundation. The USD system is built on the idea that treasuries are the risk-free asset, repo is the secured funding rail, and the dollar is the settlement language for trade, commodities, and cross-border finance. Bank balance sheets, money market funds, hedge funds, running basis trades, corporate treasurers managing cash, and foreign central banks recycling surpluses all converge on the same instrument. Treasuries as both investment and collateral. That's the setup. It's not a narrative, it's the architecture. Check. Next is expansion and overextension. The system expanded through decades of credit growth, deepening derivatives markets, and an ever larger treasury market that had to exist because deficits had to be financed. When the treasury market grows faster than the natural price-insensitive bid for duration, someone has to become the marginal buyer. Sometimes it's foreign official institutions. Sometimes it's domestic pensions. Increasingly, it's leveraged structures that require stable funding to hold the position. That includes relative value funds that buy treasuries and short futures to capture small basis differences, financed in repo. It includes bank-dealer intermediation, constrained by regulation and balance sheet costs. It includes a market that depends on smooth auctions and predictable demand. When expansion reaches that stage, the depth is less robust than it looks on screens because the marginal buyer's holding capacity is conditional on funding. Verified. Then comes the crisis channel. Yields, auctions, and term premium. When the market requires higher compensation for duration risk because inflation uncertainty rises, fiscal trajectory worsens, or volatility increases, the term premium rises. A higher term premium means the state pays more, not just because the policy rate is higher, but because investors demand extra return for holding long bonds in an uncertain regime. That shows up at auctions. You watch bid-to-cover ratios, you watch the tail, the difference between the auction stop-out yield and the when-issued yield. A weak bid to cover and a fat tail are not just bad optics. They are the market telling you the marginal buyer is price sensitive and is demanding a concession. Once that starts, it becomes reflexive. Higher yields worsen mark-to-market losses, which reduce balance sheet willingness, which weakens auction demand, which forces higher yields again. Undeniable. Now connect yields to real yields and inflation-deflation dynamics. Real yields, nominal yields minus inflation expectations, are the true tightening lever. When real yields rise, financial conditions tighten globally. That is deflationary pressure on risk assets, on credit creation, on housing, on growth. It pushes volatility higher because discount rates reprice everything simultaneously. But if policymakers suppress nominal yields while inflation expectations drift up, real yields can stay negative, which is currency debasement pressure. That pushes FX stress outward because foreign holders see their real return erode and either hedge more aggressively, raising hedging costs and cross-currency basis stress, or they reduce exposure. You can get deflationary liquidation episodes inside a longer inflationary dilution. That is the ratchet. Check. Now we move to FX moves and global currency stress, because this is where the dollar system exports instability by design. When US yields rise relative to the rest of the world, capital flows toward dollars, the dollar strengthens. A stronger dollar tightens global financial conditions, especially for borrowers with dollar liabilities and local currency revenues. That increases default risk, widens credit spreads, and forces central banks abroad into defensive tightening, even when their domestic economy is weak. That's how inflation-deflation transmits across borders. A strong dollar can be deflationary for global demand through financial tightening, while simultaneously inflationary for countries importing commodities priced in dollars. It is a squeeze, verified. Now add dollar funding stress and the swap-tossed basis layer. In a healthy system, offshore dollars are readily available. In stress, offshore dollar funding becomes expensive. You see it in the cross-currency basis, in widening FX swap spreads, and in the scramble for short-term dollar liquidity. Banks and corporates pay up to swap local currency into dollars. That is a quiet signal that the system's plumbing is tightening. At the same time, swap spreads, differences between treasury yields and interest rate swap rates, can behave strangely when balance sheet capacity is constrained. Those distortions are not academic. They reveal whether dealers can intermediate collateral, whether the market is comfortable absorbing duration, and whether hedging is functioning. When these spreads behave erratically, it means the smooth surface is hiding stress underneath. Undeniable. Now bring in repo and collateral, the real engine room. Repo is where treasuries become money. If repo rates spike, or if particular issues go special, or if settlement fails increase, that is the market telling you collateral is scarce in the places it's needed, or balance sheet is constrained, or both. Remember the core point. Liquidity is funding ability. When repo is unstable, leveraged players reduce positions. The basis trade, the strategy of buying treasuries and shorting futures to capture small mispricings, depends on stable repo financing. If repo costs rise or haircuts increase, the trade stops working. Positions are unwound. Unwinds mean selling pressure in cash treasuries and buying pressure in futures, which can widen the basis further and accelerate forced liquidation. This is how a small funding issue becomes a big yield move. Check. Now connect that to debt rollovers and fiscal reflexivity. A large debt stock means large rollover needs. As more debt resets at higher rates, interest expense rises. Rising interest expense widens deficits, which increases issuance. Increased issuance increases supply, which requires more demand, which can require higher yields. That is the spiral. Policymakers can try to counter it with financial repression, keeping yields below inflation to shrink the debt burden in real terms, but that is currency negative and confidence negative over time. They can also try to restore credibility with higher real yields, but that risks a deflationary contraction and political fracture. The system becomes cornered into choosing the least immediately painful option, and that option usually involves liquidity provision, not austerity. Verified. Now we move to market volatility and risk asset behavior, because volatility is the messenger of funding stress. When yields rise quickly or funding tightens, equities don't just correct. Credit spreads widen, leveraged loans reprice, and high-duration assets get hit hardest. That creates a negative wealth effect. It also forces institutions to de-risk, which can create mechanical selling. The volatility spike then tightens financial conditions further, which feeds back into growth expectations and risk appetite. In a mature cycle, policymakers respond to volatility not out of compassion, but because volatility threatens funding stability. When volatility threatens funding stability, the policy response is liquidity. That is why you can see rallies that feel irrational. They are the market front-running the liquidity response. Undeniable. Now we reach the stress valves, gold and silver. In the final phase of this mechanism, the system needs an outlet that doesn't depend on someone else's promise. Gold and silver become that outlet when three things happen in sequence. Confidence in real yields deteriorates, funding stress reveals fragility, and paper claims start to be questioned. Start with gold. Gold responds to falling real yields, to rising geopolitical and policy risk, and to reserve diversification. When the market believes nominal yields are capped, implicitly or explicitly, while inflation risk persists, real yields compress and gold becomes more attractive. It's not about yield, it's about preserving purchasing power and reducing counterparty exposure. Check. Silver is where the structure gets more violent. Silver is smaller, more volatile, and split between industrial demand and monetary demand. In calm times, paper markets set the reference price and physical supply is close enough. In stress, the spread between paper price and physical acquisition cost becomes the tell. If inventories in key venues draw down, if deliverable stocks tighten relative to open interest, and if demand for physical increases, you can get a situation where delivery constraints matter. Premiums rise at dealers. Fabrication lead times extend. The market can stay cheap on screen while becoming expensive in the real world. That divergence is not a curiosity. It is the start of repricing because it signals that the paper price is no longer clearing physical supply and demand. Verified. Now add the delivery and claims layer. Futures contracts are designed to be cash settled in practice for most participants, with a small fraction standing for delivery. That works when trust is high and financing is easy. But if a cohort begins treating silver as a settlement asset rather than a trade, wanting allocated metal, not exposure, then the system faces a constraint. You can create paper claims at will. You cannot create refined deliverable metal at will. Refining capacity, mine supply, recycling flows, and industrial offtake are real constraints. When demand shifts toward physical, the adjustment can express itself as higher spot, higher premiums, or both. And because the market is small, the percentage moves can be large, undeniable. Now put it all together, step by step, in the live present. The USD system relies on treasuries and repo as the base layer of liquidity. Check. Expansion has made the system dependent on continuous refinancing and stable funding conditions, with more marginal demand coming from leveraged or balance sheet constrained actors. Verified. Rising term premium and auction concessions reveal growing price sensitivity in the marginal buyer. And higher yields create collateral mark-to-market stress that feeds volatility. Undeniable. FX transmission exports, tightening through a stronger dollar and higher hedging costs, pressuring global borrowers, and forcing foreign central banks into defensive posture. Check. Dollar funding stress surfaces through basis, swaps, and repo mechanics, causing leverage to shrink and pushing yields and volatility into reflexive feedback loops. Verified. Policy is then forced into a binary that isn't really binary. Either allow a deflationary liquidation cascade, or provide liquidity that, over time, dilutes currency credibility. Undeniable. In that environment, gold attracts the no counterparty bid as real yields cap and reserve behavior shifts, while silver behaves like the pressure gauge where physical constraints and paper claims collide. Check. Now the practical reality. Most viewers get trapped because they watch headlines instead of indicators. They wait for an official declaration of a new regime. It never arrives in time. The market declares it through spreads and funding. So you watch the auction tape and the yield curve, not for drama but for pattern. You watch bid to cover and tails on key Treasury auctions, because weak demand is the first visible symptom of a system that needs a higher price of money to clear supply. You watch term premium proxies and the behavior of real yields, because real yields tell you whether the system is tightening in a deflationary way or repressing in an inflationary way. You watch the dollar index and, more importantly, specific FX pairs where stress concentrates, high debt currencies, emerging markets, and the yen when carry trade unwind risk rises, because FX is where global tightening shows up first. You watch repo conditions, fails, and the cost of financing treasuries, because that is where the liquidity is fine story can die in a week. You watch credit spreads, not just equity prices, because credit is the transmission channel of the real economy. Verified. And for metals, you stop pretending the screen is the whole market. You watch physical premiums and availability. You watch whether retail and wholesale premiums are rising, even when spot is flat. You watch reports of inventory drawdowns in key storage venues, and the behavior of spreads that hint at tightness. You watch the relationship between futures pricing and physical delivery incentives, because backwardation risk and persistent tightness can be signals that the market wants metal now, not later. You watch central bank behavior in gold, because reserve shifts happen quietly and matter later. Check. Here is the warning cleanly, because it has to be said without comforting language. This time is not different. The mechanism doesn't care about national pride. It doesn't care about American exceptionalism. It doesn't care that the S&P has great companies. It doesn't care that you can say tech will save us and point to productivity fantasies. Modern optimism is not a hedge against funding arithmetic. Those are stories people tell when the loop still closes and they want to believe it always will. So how do you avoid becoming the liquidity exit? First, you stop anchoring your decisions to a single forecast number and instead anchor to the sequence. If auctions weaken and term premium rises, you respect that yields can climb even if growth slows. If real yields compress because the system can't tolerate them staying high, you respect that currency credibility is being traded for funding stability. If FX stress accelerates and hedging costs jump, you respect that global dollar shortage dynamics are back. If repo and funding spreads begin acting wrong, you respect that leverage is being forced out and volatility can cascade. And if physical premiums and availability in metals diverge from paper prices, you respect that settlement. Demand is appearing undeniable. Second, you build a dashboard mindset, not dozens of indicators, just the ones that reveal the machine. Treasury auction strength, real yields, term premium behavior, dollar strength in stress pairs, repo funding stress signals, credit spreads, and metals physical versus paper divergence. You don't need to predict the day. You need to recognize the phase. When phases change, portfolios that were fine become traps because they were funded, not owned. Third, you treat risk like a liquidity problem first and a valuation problem second. Most people lose money not because they were wrong about the long term, but because they were forced to sell at the wrong time. They were the liquidity exit. They held assets that required continuous calm. In the final phase of the mechanism, calm becomes a policy product, and policy products fail when they become too expensive to maintain. If you want to stay ahead of this, keep coming back to the pipes. Watch the auctions. Watch the funding. Watch the FX stress. Watch the real yields. Watch the physical market signals that cannot be papered over forever. And in the next video, we're going to go even deeper into how the machine was built, why the collateral hierarchy makes these outcomes predictable, and how the next stage hits before the public realizes the regime has already changed.